All right. So, the end of 2019, government decides that they're going to give us a whole set of new rules for retirement accounts.
Sure. 2 weeks right before the end of the year. Whole 2 weeks.
And some of them, Graham, go back to January 1, 2018.
Not just January 1, 2019, but 2018.
2018, the tax return that we've already finished. So there's believe it or not, there's a funny CPA that I go listen to. His name's Walter Nunnally. And, when people talk about complicated things, they always say, this is like rocket science, or this is like brain surgery. And, Walter says that, when a rocket scientist wakes up, the law of physics haven't changed.
Mm-hmm.
When a CPA wakes up, every day you could have a whole set of rules that have to be relearned again. And so when something's complicated, you should say, this is not CPA work,
This is not. I think Albert Einstein has some kind of quote about income tax. And I think you said basically that physics stays the same.
So it's the same.
Tax is a little different.
Changes all the time. So anyway, you got the Secure Act. We've got some important, let's just talk about those retroactive back to January 1, 2018. So first you had mortgage insurance premium. So when people borrow more than 80% of the value of the house, they have to take out mortgage insurance. Mortgage insurance has always been considered like interest, but it requires Congress to decide that it is deductible like interest. Mm-hmm. And they always would extend it and say, yep, you can deduct mortgage insurance premiums. In other words, they didn't put it in the law. They made it an extension every so many years. They had to say, okay, we're extending it for another 2 years, another 5 years, or whatever. I don't want to get into the reasons why they do it as an extension as opposed to a permanent. But in 2017, they did not extend it. So in 18, you were not able to take the mortgage insurance premium deduction. At the end of 2019, they say, oh, by the way, we're going to extend mortgage insurance premium deductions as interest. And we're going to do it retroactive back to January 1, 2018. So that if you did your return in 18, you didn't get your mortgage insurance premium deduction, you can go and amend your return and get it now. Now, just think of how many people aren't going to know this because they don't get our video or and going to lose this because they do all these absolutely insane things with the tax laws.
Makes absolutely no sense.
Anyway,
it keeps us in business, but it makes no sense.
The second thing is tuition deduction. So if you paid tuition, you could either have the American Opportunity Credit or you could have the Lifetime Learning Credit. Well, the problem with those credits are that not everybody is in an undergraduate program. So if you pay tuition and you're not in an undergraduate program, you can't get the American Opportunity Credit. So that's number one. Number two, the Lifetime Learning Credit is such a low income threshold. It's like $80,000 married, $30,000 or $40,000 single. Not many people are going to get that and be able to use that credit. But there was a third one. It was called the tuition expense deduction, and you got up to like $130,000 of married filing joint income. And a lot of people would take advantage of that tuition expense deduction because they couldn't get the other two. Well, they didn't extend it in 18. So you didn't get that deduction. Well, now they've extended it for 19, and it's retroactive all the way back to January 1. So anybody who paid tuition in 2018, even for part-time tuition, and they didn't get a credit, either the American Opportunity Credit or the Lifetime Learning Credit, that return has to be amended also.
And there's one more reason that we might need to do some amending.
Well, there's actually two. There's a second one that is the $500 lifetime energy credit. People who did new windows, new doors, a new heating and air conditioning that's SEER 15 or whatever they call it, the high efficiency energy unit. you get a $500 deduction, but it's a once in a lifetime. You get the $500. And it's anytime between 2005, when it first came out, to 2020. If you've already used it, it's irrelevant. But in 2017, they didn't extend that. Now they've extended it, and it's retroactive back to January 1. So if somebody did something in 18, they have to amend that return to get that $500 credit, because technically, if they try to take it on the 19 return, the IRS could deny the deduction if they looked into it, because you spent the money in 18. You have to amend the 18 return. And then lastly is the kiddie tax. So that's when a child has unearned income, interest and dividends, and they're under 24 years of age, or they're under 18 years of age, and they're not going to college. So depending on whether they're going to college or not, whether
under 24, but you're in college,
or under 18,
or under 18, doesn't matter if you're in college.
Doesn't matter if you're in college, and you have unearned income, capital gains, interest, dividends. The way the law worked in the past is it was taxable at the parents' rate. In the 2017 Tax Act, they changed that for 18 to be the trust rates. Okay. Here's the funny thing, though. A trust pays the absolute maximum 37% tax bracket at $12,800 of income very quickly. An individual, my parents, let's say, won't hit the maximum tax bracket until, you know, it's like $600,000 in 2018. So there are a lot of people that might have paid the kiddie tax at the trust rate and paid substantially more in kiddie tax, taxes under the trust rate, that can now go back and amend it using the parents' rate. And in 2019, you can either use the parents' rate or the trust rate, whichever works out better for you. And then in 2020, you're stuck with just the parents' rate.
The parents' rate. So the message here, the action item is...
Message is my mind is hurting.
Your mind is hurting, and so are probably a lot of our listeners here. So if your mind's hurting, all you need to do is, if one of these applies to you, you think they do, you just contact us.
Yeah, because our mind's already hurt, so we might as well
hurt our minds together.
We just might as well take care of it and turn lemons into lemonade.
Might as well.
Anyway.
So the big one, this is one of the highlights of the Secure Act, and that is the required minimum distribution age changed from 70.5 to 72. The caveat to that is that for any of the poor souls out there that already started their RMDs because they turned 70.5 or older in 2019, this unfortunately does not apply to them. They're stuck with what they have. So they'll be 71 next year, not 72, but because they already started, they have to keep taking it.
Right.
So
we had a client just the other day born in December of 1949. So she turned 70.5 in June of 2020. So the new law applies to her.
Well, yeah, she's one of the lucky ones.
She gets to wait until now 72, which would be 2021. She's not going to have to take an RMD in 2020 because of this new law.
Sure. Well, and one of the great things that Congress decided to do, confuse us, make our herd head a little more, is qualified charitable distributions. They're still 70.5. Right. They didn't change to 72.
So the qualified charitable was tied to when you begin your required minimum distribution at 70.5 under the old law. They now increased the RMD date, the required beginning date for required minimum distributions, to age 72, but they leave the QCD, qualified charitable, at 70.5. But you actually have to be 70.5 or older in order to take advantage of that. But then they confused it a little further with the QCDs.
They did.
But we'll talk about that.
We're not going to, if you want to know more about that, then you let us know.
Yeah, that's true. So the stretch is dead.
This was another big one.
What is the stretch, Graham?
So when people would inherit IRAs, they had their entire life expectancy to take out a little bit at a time. So someone inherited an IRA and they were 40 years old.
From like their parents.
From their parents.
Right.
From their
not
parents.
A spouse.
Not a spouse. Parents. Exactly. They inherit, let's say they're 40 years old. They'd have almost another 40
45
years, 45 years to take a little bit out at a time. Well, this new law has basically said for most people, that's no more. You
Right.
have until the end of the 10th year, which is December 31st of the year that the person was deceased.
Yeah, so somebody dies on January, what's today right now? January 9th, 2020, all right? You have 10 years from December 31st, 2020 to get the money out of there. So you have until December 31st, 2030 to get the money out of the account. Even though the client died in January of 2020, technically you almost have 11
years.
Almost 11 full years to get the money out.
Well, and that's an important distinction. So before, you had to take a little bit out every single year. For this, it's just all of it has to be out by the 10th year. You could choose to leave it all in there by the end of the 10th year, or you could take out a little bit at a time, but the only requirement is that all of it's taken out by the end of the 10th year.
Which we're going to get into this later,
yes.
But that's why Roth IRAs are incredibly important now, because they're tax-free and they get the compound tax-free. So under the old law, I had to take my inherited Roth IRA from my parents a little bit at a time as I got older and older and older until it was liquidated. Now I can just let it sit without any withdrawals for 10 years, grow tax-free, and 10th year, take it all out 100% tax-free.
Exactly. So let's just dive into this a little bit. So think of someone inheriting $100,000. If they got to keep that in there for 10 years and it grew to, let's say, $500,000, at the end of the 10th year, if they decide that's when they're going to take it out, a traditional IRA, you've got to pay tax on $500,000. The beauty of those Roth conversions and making that be Roth money is that $100,000 that turns to $500,000. The $500,000 is completely tax-free.
Right.
Yeah.
And if you think about it, if you inherit a big IRA that's pre-tax and you got 10 years to get it out, even if you take it 1/10 at a time, you could be talking big numbers.
Oh yeah.
That, it's going to be difficult to liquidate a pre-tax IRA in a tax-efficient manner. That's why it's going to require some significant generational planning.
Absolutely.
So,
and I think one of the things we want to tell everybody is that, this is for anybody that received an inherited IRA. It's changed after after December 31st of 2019. So this is all existing beneficiaries. Everything is really staying the same.
And just to complicate things a little
Even
more,
there are exceptions.
So if I'm a surviving spouse, they still have all the same old rules that they used to have.
Yep.
If I'm a disabled individual, let's just call it, if you can qualify for disability with Social Security, then you would be able to take a life expectancy payout instead of a 10-year. You have an actual right to choose either the 10-year payout or the life expectancy payout, whichever you desire to take out. The second one is chronically ill. Chronically ill is a lot like long-term care. You can't toilet yourself, you can't feed yourself, you can't walk yourself, or something of that. That chronically ill one also can take it out over a life expectancy or 10 years, whatever they prefer. And they have to actually get a recertification on an annual basis to say that they're chronically ill in the definition of the Internal Revenue Code. Yeah. Lastly is minor children. Minor children get a life expectancy payout. And it's only the children of the account holder. So let's say grandma leaves me her pre-tax IRA. I have 10 years to get that out. But let's say dad dies and I inherit dad's IRA and I'm 10 years old. Now I get a life expectancy payout until I hit my age of majority. What is the age of majority?
Which what I'm reading is that it's 18 for this particular reason, and then when they basically turn 28, they have to have it all taken out.
Yeah. Now,
but
I have seen other people say that the age of majority is going to depend on what state you live in as to what is considered the age of majority. But I take your point. just consider it 18 for now until we get better clarification of it.
Yep.
So a 10-year-old receives an IRA. They can take out a little at a time for 8 years. And then in the 8th year, when they're 18, they have 10 years to get that out. They can stop taking withdrawals and then wait and take all of it out in the 10th year, or they can take out little bits or whatever. But the minute they hit that quote unquote age of majority, they got 10 years to get it out.
10-year clock.
There's a last beneficiary that has the life expectancy payout or the 10-year, whichever they choose. And that is the beneficiary who's less than 10 years younger than you. So I choose my brother, a sibling. And my sibling inherits. They're only 3 years younger than I am. They can take a life expectancy payout, even if that's 20, 30, 40 years down the road. They can take out a little at a time if they so desired. So, you know, so you've got disabled, chronically ill, minors, and a beneficiary who's 10 years younger, who's less than 10 years younger than you, can still use the life expectancy, or they can choose to do the 10-year. And again, the strategy for this is Roth conversions, generational Roth conversion planning, because the minute it's inherited, you can no longer do a Roth conversion. So parents, very important, parents, think about talking with us about Roth conversions and doing them tax efficiently to get this money into these tax-free accounts.
And the one other thing that they need to make sure they reach out to us on are if they think they have trusts as beneficiaries for retirement accounts. Because of the way the languages can be written, there are instances where we would want to change things. And because the law is now in effect, if they pass away without reviewing that, it can mean a pretty big problem if it's not corrected or if it's not the way we want it to be.
That's absolutely correct. So let's go on to the next one. So maximum age for IRAs contributions. So it used to be that when you hit your required beginning date, 70 and a half, you could not do a pre-tax or non-deductible traditional IRA contribution. That's now waived. Even if you're 90 years of age, if you're still working, making earned income, W-2, self-employment income. Those are the typical ways of making earned income. Mm-hmm. It's very important. A lot of people, we throw these terms around and we know what it means, but earned income is working, self-employment, wages, W-2s. You have one of those and you're over 70 and a half, you're now able to do a traditional IRA contribution. And the planning opportunity here is the non-deductible IRA.
Yeah, and especially for a lot of the people that we're talking to, the non-deductible contribution can be a great strategy.
Well, then what we're using that for is it's a high-income person that's still working, mm-hmm. and they're unable to do a Roth IRA because their income's married 190,000, 195, let's call it, mm-hmm. 125 if you're single. Your income's way over that. Your total income, not just your wage income, but your total income's way over that. You can't do the Roth IRA. The non-deductible IRA contribution is a way to do that in a two-step kind of process, and it's a way to accumulate more of that Roth IRA money mm-hmm. that we were just talking about. Yeah. But we didn't have this strategy until this law passed. And now 2020 onward, clients over 70 and a half can now do these non-deductible to Roth contributions.
And that's the action. If you're 70 and a half or older and you have earned income, just reach out to us and we can figure out the best plan.
All right.
So this is a fun one
for the Graham.
For me. So maybe I'll use this. We'll see. But the new exception to the 10% penalty is childbirth and adoption. So this actually applies to both IRAs and to company plans, so 401ks, things like that. You're actually able to take out $5,000 from that account, penalty-free. It can't be taken out before the birth, has to be after. And then for adoptees, they have to be under 18 years of age. And the important thing to note is that when you take money out of a 401k plan, almost every single time there's a mandatory 20% withholding. Well, with this exception, there is actually not a mandatory withholding, so you get to avoid that headache a little bit. And then there's also an interesting provision where there's an option to actually pay it back. So there's a couple of ways you can get money into an IRA or 401k, and most of the time it's either a contribution or a rollover.
Right.
And this is now just a kind of very unique other way to get the money back in if you were to use this strategy. But I think we need a little more clarity on really what that repayment looks like.
Yeah,
So
and
I'm
I
sure
don't
we'll see
think
more
I
in the
don't think a
future.
lot of people are ever going to use this because
No.
you have other exceptions like the first-time home
You
buyer
do.
and the health insurance and the higher education that you can withdraw money without penalty.
Mhm.
And I can't tell you, but maybe 3 times in my
Exactly.
career that I've ever used the strategy. So,
Mhm.
but the reason that it's the Graham provision is in 2 weeks or so. Little Graham is little Grammy.
Grammette.
Gramia
Yeah.
is coming on the scene.
Yeah,
So
we'll see. Any moment now.
we're
I
looking
might have to
forward
race
to
out
it.
of here halfway through. We'll see. The number 6.
Annuities can now be offered within employer 401k plans. This is important because annuities are complicated, difficult investments, and they aren't necessarily the best investment for clients. But many people think and feel good about annuities, and the insurance industry is a big lobbyer of Congress, and they managed to get this law passed to sell these annuities inside of 401k plans. My point would be extreme caution of any annuity that is offered inside of 401k. Look, we're fee-only independent advisors. We do not care whether a client wants to put money into an annuity or stocks or bonds or CDs or real estate or whatever. It doesn't matter to us. We're fee-only advisors. We can go to annuities and use them. But we choose not to in a lot of situations because insurance companies have never proven to be magnanimous.
They're not necessarily looking out for your best interest.
They're not benevolent, and they're not usually in your best interest. And the way they wrote the law allowing annuities to come in there is they're basically said, well, if we allowed these to come in, most plans would not offer them because they breached their fiduciary responsibility of watching out for the best interest of their employees. So what they did is they gave an exemption to the protection of the fiduciary to say, if you offer an annuity and it's just an approved product in your state, or in states around the country,
it's properly licensed.
It's in good. The insurance company is in good standing and has been for the last 7 years. They have had their financial examination and they passed it for at least the last 5 years, and nothing's changed of the above. The fiduciary has no risk. And think about it. You see these products, Graham, that come out with 10% surrender charges and 10% commissions and all kinds of phony baloney, high expense stuff in them. And, a big company with millions and millions of dollars of their employees' money can now offer that kind of an awful annuity and have no risk from the employee finding out that they got a bad deal.
Well, and I think one of the scenarios that is a big problem is if what's the backing of this annuity product? It's an insurance company.
Yeah.
You don't own a company the way if you bought a share of Apple, you don't own a share of anything. Your backing of that asset is on the insurance company. So if you have a company that might be strong now, but 20 years, 30 years down the road when you're ready to retire is not as strong, and that annuity is not worth as much or anything, that could be a huge problem. And that's what this this act has basically changed is before, fiduciaries of 401k plans could be held liable for something happening like that. Now, they just have to do these couple of things and they're okay.
And you're gonna, I'm gonna hope that big companies are
Right.
not going to allow an abuse of this to their employees.
Sure.
But you know what I'm worried about? I'm worried about all those companies with 25, 50 employees that some insurance agent is the plan, is implementing the plan, and they see this as an incredible opportunity to ram these products with high commissions down the throat of the employees of the company, and the business owner has no risk whatsoever. And the business owner may do it themselves because they don't know any better.
Yeah.
I just very disappointed in Congress. I understand the concept. It
can be a great concept. It's just
some annuities can have a place in a client's portfolio, but it has to be very low cost. You have to strip the commissions out of it, and it's got to be with the right type of insurance company under the right investment criteria. And that's where it gets difficult, because you have indexed annuities, you have variable annuities, you have all kinds of different payout structures. It has to be thought out, and this is just an embarrassment that they allowed the insurance companies to do this. And I'm just saying that if you work for a company and they start offering these annuities, be extremely cautious. Homeschooling 529 plans, two provisions. You could take $10,000 out per year to pay for homeschooling. That's a good one. I got a lot of clients that do homeschooling. They spend money every year, and most homeschoolers spend $5,000-$10,000 a year to go to different classes and get resources online and things of that sort. So now you can get the deduction from the state of Maryland for that, but you also have the other one, Graham.
And the other one is that you now can use up to $10,000 of 529 plan money to pay off student debt.
Right.
And that actually can be extended to siblings as well. So say my parents have a $20,000 529 plan for me, I could take $10,000 of that, pay off some student loans if I had them, and then they could use $10,000 for my sister as well.
Right.
But the important thing to note is that's not annual. That's not an annual limit. That is a lifetime limit.
The homeschooling one's $10,000 a year.
That one is
the student debt is a one-time lifetime payout.
Yeah.
I just had a client the other day ask about that. She says, they have 3 kids, and they said, if I want to pay off some of our children's student debts, can I use the 529 plan? And the answer is yeah. They could set up one 529, put in $30,000 for all 3 of their children, set it up, let's say, under little Drew's account, and then take 10 out for Drew, 10 out for Joni, and 10 out for Billy, and boom,
there you go.
You get the deduction.
Well, and someone might ask, well, why would you have student loans if you have this money in 529 plan money? And the strategy here is that if you do have student loans and you didn't have 529 plan in the first place, 529 plan money in the first place, you can open up one after, contribute to it, get the state deduction if it's offered in your state, and then pay it off.
Yeah. Now we talk about it as if it is because we live in Maryland. And Maryland does give $5,000 per year deduction, and it's a carryover. That's $5,000 for a married couple, $2,500 for a single, and it's a carryover. So if I put in 10 per child and I had 3 children, I'd get 5 per year for each of the 3 children. That's 15. And I'd get it for 2 years because it can carry over for 10 years the rest of the money. So,
but Pennsylvania works a little differently. You can put in $15,000 per year into any plan in the country right now.
And so they could get the whole $10,000 in 1 year.
They get the whole $10,000. But if you put in more than $30,000 for a couple, it doesn't roll over the way it does with Maryland. But that's more details.
And remember, again, the student payoff is a $10,000 once in a lifetime.
Once in a lifetime. And the last thing with this is that while some trade schools were already acceptable institutions for 529 plan money, this just expanded some things with apprenticeship programs, things like that. in addition to what was already there.
All right, employer benefits. We're going to just end on this. It's not going to apply to a lot of our clients listening. If you're a business owner, you now have a credit of a substantial credit to start a 401k plan. If you've never had a 401k in your business and you start it, they're going to give you a fairly substantial credit. Matter of fact, we have a client that I'm going to go see soon to setting up a 401k. And basically, the credit is going to cover the entire cost of the plan for the next 3 years. And they may even actually get more money than it's going to cost them per year. Yeah. And then there's a second credit if you force auto enrollment. Now, that's a psychological thing that's become very important to the government. You see it with Medicare Part B, that if you're on Social Security, you're auto-enrolled in Medicare Part B. You have to say, I don't want Medicare Part B. You're automatically enrolled if you're already getting Social Security. Why do they do this? What's the importance of auto-enrollment? Well, psychologically, there's studies proven that if you say, sign up for Medicare Part B, only 20% of the people will sign up for it. If you say to them, unenroll from Medicare Part B,
only 20% will unenroll.
Well, very few will unenroll unless they absolutely know they have to. Yeah. And so by forcing 401k enrollment, you're going to have almost 80% of the employees of that company enrolled at some level, as opposed to if you say to them, enroll, you'll only have 10 to 20% of people enrolled. So it's a way to force enrollment and help employees realize if you have a little bit taken out of your paycheck per pay period, you're not going to miss it. Yep. And you'll have this nest egg starting to grow and accumulate for the long term. And they're giving you a credit if you force this auto enrollment. Yep. And the auto enrollment used to be only up to 10%. They've expanded that now that you can auto enroll up to 15% of the employees' money. I don't think many companies are going to do 15%, but they're encouraging them to try to force auto enrollment at about a 5% level with an automatic escalator every year.
Up to 6%.
Yeah, up to, and then it ends at 10 sometime around the 10th year when they're with the company that they're, they auto enroll at 5 and then slowly but surely goes to 5.5, 6, 6.5, 7. And by the 10th year, then they're at 10%. And, it's up to you to continue to force it higher. And there's another credit when you do this auto enrollment. So this client is going to get the auto enrollment credit and the credit for the initial first setup. And it's a nice little deal. So if you have a company and you don't have a 401k, now's the time to do it. That's the end of this. But I just want to say, 2020 is going to be critical that all of our clients meet with us for a personal financial review to go over all these important issues that are going to be taking place in the Secure Act to make sure, do you have a trust as a beneficiary? Is that trust right? Do you have IRA money? Do you have a lot of pre-tax money? How are we going to get it out? How are we going to get it in Roth? Make sure that your contributions to your 401k are going to the Roth unless there's a specific tax reason that it needs to be going pre-tax right now. Yep. I think the Roth becomes a big opportunity now, and all my contributions go Roth. But I can tell you, there, people who make between 150 and 175,000 or 180,000, and they have children in college. You need to be doing the pre-tax because it could make a huge difference in what happens on that tax return. People who make 170,000 and they're on Medicare, they may need to be doing pre-tax to get them down below that 170,000. So there's lots of new things that you have to think about.
A lot of opportunities.
All the laws have changed, not the laws of physics, but the laws of taxes have all changed, and we have to be cognizant of how we're going to execute and implement new strategies. So be in touch with us in 2020. We look forward to talking to you. That's the end of this Secure Act talk. It's Drew Tignan saying God bless.